you go back a few years ago and your bond interest tax rate was 77 cents per $100 of EAV, but because of your solid EAV growth, that has decreased to 68 cents. And as part of the plan, I'm pointing this out just because as part of the plan of finance with the life safety bonds, we want to bring that back to approximately 72 cents. So not all the way back to where it was a few years ago, but by recovering about 5 cents of that, we're able to amortize and pay down the life safety bonds quicker than we otherwise would be able to. And there's a lot of the payments highlighted in yellow. Yellow means that those payments are callable. So when we talk about your bond issues, we like to make a lot of comparisons to what we have as individuals and what do we have as debt, mostly car payments and mortgages. Well, both of those items you're able to pay off whenever you want to. You don't have to wait to a point in time. When it comes to municipal bonds, you got to wait to something that's called the call date. And that's usually 8 to 10 years after the bonds are issued. It varies depending upon a variety of factors. So those yellow payments are all callable. And at the bottom of the column, you can see when the call date occurs. So that's when they first became callable, and then they're callable anytime after that. So the two bond issues that we're focusing on tonight that are callable now are the 2015 bonds and the 2016 bonds. I'm going to talk a little bit more about the characteristics of those bonds on the next slide. But you can see you have other callable payments, but those call dates aren't until 2027 and 2027 for the 17, 18, and 19 bonds. So if market conditions stay similar to where they are today, we'll probably be talking about a refunding opportunity next year too. So, and refunding, that's the word we use in our industry. Refunding is just what we use for refinancing, okay? So the characteristics are described on the next slide if you want to go ahead and advance. So 2015 and 2016 bonds, and both of these were issued pursuant to the referendum authority to build the new elementary buildings. And the interest rate on the 15 bonds is 4%. And that is higher than what you can get today on that area of, we call it the yield curve. And now some of us are like, wait, the district can get a lower rate than, I've seen mortgage rates are 6%. How can the district, well, first of all, mortgage is going to be 15 to 30 years. This bond issue, this principal refinancing, is a relatively short portion of the structure. If you go back a page, you can see, Ryan, the 2015 bonds only have 6 payments left. So that's one factor. The other factor is you're a large unit of government. You're safer risk than us as individuals, homeowners. Plus you get the benefit of tax exemption, meaning the bonds, when you sell them, the interest payments that you make to your investors, they don't have to pay taxes on it, so they give you an even lower interest rate. So it's a combination of all those factors why you can actually get a rate lower than 4% on those maturities. The 2015 bonds, you have about $21.5 million of that are callable. Now the interest rates, thank you, Ryan. The interest rates on those maturities vary. 2027 through 29 have a 5% interest rate, and then the 30, 32, 34, and 35 have 4% rates. The years I didn't mention have rates that are 3-something. So those we would leave outstanding. That's one thing that's different too between our home mortgages. You either refund it, refinance it all, or none of it. With your bonds, it's like each one of those principal payments is like its own bond. So you can choose to refinance some and not refinance others if the interest rate on those are too low. So next slide. This is the estimated savings. So the first column of numbers there is what we estimate the refinancing component of the bond issue would be on January 12th. We're right about there today still on the interest rate, so I didn't really have to update this. We add that to the portion of bonds that aren't refinanced. Those are the ones with the interest rates being too low. So you add that together, you get net new payments or net new debt service. And compare that to the old, that yellow column shows the estimated savings by year, which totals up to $681,000. Now, because that savings will happen over time, not up front, financial analysis says we do a present value of that. It means we take this savings each year and we put it back into today's dollars. And that's what the bottom yellow number is $588,000. So that's a pretty strong number. It's not as strong as you got in the past. Interest rates are higher than they were during the height of COVID, but it's still very strong savings that it reduces the tax levy for these bonds. So this doesn't go to the operating funds. This goes to reducing the levies to pay back your debt service. Go ahead and advance, Ryan. So this slide gives you an idea of the market conditions over the last 3-ish years. So the gray area represents the federal funds rate, just so you have the context of where monetary policy is. And as we know, rates have been coming down on the Fed funds rate. They did vote to keep them flat today, and that was expected. There was no surprise to the market, and the market already factors in what it expects to happen in the future. There's no need to wait for the rate cuts to happen, which are anticipated maybe 1 to 2, depending on who the next Fed chairperson is. But the market already factors in those cuts as if they've happened. The market really adjusts when changes happen to underlying expectations. So if you focus on just that solid blue line, those lines represent an index of municipal bonds. Just like the Dow Jones Industrials, S&P and 500 are used for the stock markets, we use this index to monitor trends in the municipal bond market. So if you look at that dark blue rate, that's the 10-year point in the index. It's not necessarily meant to show you where you would borrow or any individual school district would borrow. It just gives you an idea of trends in the marketplace. You can see since November, pretty much since the government shutdown, it's been fairly stable. And so we're hoping for a stable market going into next month when we anticipate the bonds would be sold, subject to the board's approval tonight. Things that could upset that would be, we do have a job report that comes out the beginning of February. That's probably what our focus is on. And then of course there's always political risk, right? What could be something that disrupts the market. The little bit of a blip that you saw there in the green line, where it went up a little bit here recently, that was when the Greenland discussions were at their height. And so, those topics impact the market. So the next slide is the life safety bonds. So we're targeting net proceeds of $16.2 million, and we're using current market conditions for this analysis. And we've included the estimated savings from the refunding in the graph that you're going to see. For EAV growth for levy year 25, that's for the taxes coming out this summer. We assume EAV is going up another 6%, and I think news from Adams County is probably slightly higher than 6%. And then conservatively 2% thereafter. And we're, again, going back to target to match the bond interest tax rate that was in levy year 23, which is 5 cents higher than it was last year. And then the rate would begin to decline again in levy year 29, which provides flexibility to do additional life safety bonds if necessary. Working with Ryan, we've talked about when that next need might come up, and it's around that time. So we've always been very prudent about planning the financing so that there's a structure in the repayment terms so that you can issue those new bonds without a significant increase in the tax rate. So the next slide is the graph of what I just described. So you can see levy year 23, that was the taxes collected in 24. The green line shows the bond interest tax rate. Last year it dropped by 5 cents. Our target is just take that right back up to where it was in levy year 23 and then keep it the same. So the new bonds, the life safety bonds, are those blue columns. Those are right on top of your current payments. So they increase slightly for the next 3 years after that, reflecting the 2% increase we're assuming in EAV, and then it would decline. If you have no need for life safety bonds at that time, then the bond interest tax rate would decline. But if you do, when you get to levy year 29, you'll be able to reissue some life safety bonds and hopefully keep that tax rate the same. The life safety principal payments, there's some principal payment at the beginning where you see those taller blue bars, but the bulk of the life safety principal is placed in 2037, 2038, after the bulk of your referendum bonds have matured. So most of the time you're paying these bonds, like when you did the bonds for elementary school, you paid them off over 20 years. These life safety bonds, you're paying them off in 14-ish years, I think, if I counted right, quickly. Any questions on this picture? Okay, so the next slide, I'm not going to go over this. It's just a detail. If you Later on, I want to look at the numbers that go into the graph. This is those numbers. So the last slide are the next steps. The board has before tonight the resolution to consider authorizing both the sale of life safety bonds and the refinancing of the outstanding bonds that we discussed. And one thing that could happen too is it's not an all or none thing on the refinancing. If rates tick up a bit and it still makes sense to refinance some of them, we can refinance some of those and leave some of the other ones out. That's something we'll be coordinating and talking with the administration about and making that decision. The resolution doesn't just authorize me to proceed with the sale or even Ryan. The sale has to be signed off of by delegates of the board. Those delegates are Ryan and the interim superintendent. Bonds are anticipated to be sold on February 9th. You know, that's a Monday. We like to do Mondays because the bigger national issues tend to come out on Tuesdays and Wednesdays. So we want the investors to focus on your bond and not some $300 million bond in some other state. And there's no. Yeah, it's the day after the Super Bowl. Hopefully, no, I don't think that'll be a problem.
Okay, all right.
With remote work, they can buy their bonds at home. But there's, other than people returning from the Super Bowl, there's no major economic reports on the 9th. I think CPI comes out later that week, and we're trying to avoid that CPI report. And then, assuming a successful sale on the 9th, the bonds would close on March the 9th, at which time the old bonds would be refinanced and paid off, and then you would receive the proceeds for the life safety bonds, and then you can begin that work this summer, I think.
Muddy River News. Our home, our news.